I was assigned to discuss about the two chapters of Investment in Associates. Investment in Associates basic principle has technical knowledge, which are to understand intercorporate share investment, to know the meaning of significant influence, to identify the factors that indicate significant influence, to understand the equity method of accounting for equity investment. When we say intercorporate share investment, ito yung pagbili ng equity shares ng isang entity by another entity. Or in case na ang isang entity ay nag-invest in another entity sa pamamagitan ng pagbili ng share capital. Or ang isang entity ay bibili ng enough share ng another entity in order to exert significant influence over the financial and operating policies of the investee entity.
Significant influence. PAS 28, paragraph 6 states that if an investor holds directly or indirectly through subsidiaries 20% or more of the voting power of the investee, it is presumed that the investor does have significant influence unless it can be clearly demonstrated that this is not the case. Meaning, kahit 20% or more ang investment in a certain company, if it is clearly stated or demonstrated that the investor do not have a significant influence over the investee, then the investment is not an investment in associate.
Of significant influence usually evidenced by the following: representation in the board of directors, participation in policy-making process, material transaction between the investor and the investee, interchange of managerial personnel, and provision of essential technical information. Special voting rights arises when new shares are being offered to the stockholder. It means if i-exercise ng stockholder na bilhin ang stocks because of preemptive rights, there will be changes sa share on profit and losses. Loss of significant influence can occur with or without change in the absolute or relative ownership interest. For example, pag si associate nagiging subject to control of government, court, administrator, or regulator, also occur as a result of a contractual agreement.
Equity method is the method used or applicable if ang investment ni investor kay investee is classified as investment in associate. Accounting procedures. Sa accounting procedures, every time the investor receives a portion of the investee's income, it adds up to the investment balance. And every time naman na makareceive ng dividend sa investor from investee, it is deducted from the investment balance. Illustration Equity Method. On January 1, 2019, an investor purchased 20,000 shares of the 100,000 outstanding ordinary shares of another entity at 200 per share. The investment represents a 20% equity interest, and the investor has a significant influence over the investee. The acquisition cost is equal to the carrying amount of the net assets acquired. The journal entry would be investment in associate 4 million, cash 4 million. We come up of 4 million because 20,000 shares multiplied by 200 per share. That's why 20,000 multiplied by 200 is equals to 4,000. So, number 2, the investment reported net income of 5 million for 2019. The investor recognized a share of the net income of the investee equal to 20% of 5 million or 1 million. So, ang journal entry is debit investment in associate 1 million, credit investment income 1 million. How it comes in 1 million? Kasi nga, sabi dito, 20% of 5 million, which is 1 million, ang investment in associate. So, na-state din dito na net income of investee equals to 20% of 5 million or 1 million. That's why investment of income is 1 million. Number 3. Receive a 25% share dividend from the investee on December 31, 2019. Memo. Receive 5,000 ordinary shares as 25% share dividend on 20,000 original shares. Shares now held 25,000 shares. Note that the 20% equity interest is not affected by the share dividend. The equity interest is the same before and after the share dividend. Number 4. The investor reported a net loss of 1 million for 2020. The investor recognized a share in the net loss of the investee equal to 20% of 1 million or 200,000. So, the journal entry would be loss on investment 200,000, which is 1 million multiplied by 20%, and investment in associate 200,000. Number 5. The investee declared and paid a cash dividend of 2,500,000 on ordinary share on December 31, 2020. The investor recognized a share in the cash dividend paid by the investee equal to 20% of 2,500,000 or 500,000. Journal entry would be cash 500,000, investment in associate 500,000. Note that under the equity method, cash dividend is not an income but a return or reduction of investment. Excess of cost over carrying amount, meaning ang gibayad ni investor for the assets acquired over the investee is much higher than the carrying amount of the investment. Such as for the example, sa investee may net assets na 20 million, then nag-invest sa investor for a 20% interest in the investee's asset and paid 5 million. So, diba, ang 20% of 20 million is only 4 million. Pero, the investor paid 5 million. So, ibig sabihin, the 1 million na difference may be attributed to undervaluation of the investee's assets or goodwill. Excess of net fair value over cost. For example, in the problem given, diba ang 40% of 30 million is only 12 million pero you paid 15 million. So, ibig sabihin may 3 million na excess of cost over carrying amount. Pero may additional details ang problem. It says that the equipment was overvalued by 7 million and the inventory was overvalued by 2,500,000. So, taking the 40% share in the overvaluation of the equipment and inventory would come up to the remaining amount of 800,000 as excess net fair value over cost, and that 800,000 would be considered as investment income. Investee with heavy losses. Based on the given example, acquisition cost mo is 5 million, so that is your investment in associate balance. But then, 3 consecutive years na may heavy losses ang company, and that losses is greater than your investment balance. Let's say, in the first year, may share ka in loss na 250,000. So, at the end of first year, 4,750,000 na lang ang investment balance mo. Then, pagka second year, another share in loss naman na 2,500,000. So, meaning, at the end of second year, ang investment balance mo is 2,250,000 na lang. Then, sadly, during third year, may share in loss ka na 3 million. So, di ba, ang investment balance mo is 2,250,000 only, pero ang share in loss mo is 3 million, which is much higher than your investment balance. To offset ang profit mo ng 500,000. So, in the fourth year, wala ka na entry. Then, during fifth year, nagka-share ka sa 625,000. So, di ba, may unrecognized loss ka na lang 250,000.
So, i-offset mo anay ang unrecognized loss mo nga 250,000 sa 625,000 mo nga gain. So, ang i-recognize mo lang na gain is the 375,000.
Impairment loss shall only be recognized when the amount of the investment in associates exceeds its recoverable amount. Recoverable amount is measured as the higher between fair value less cost of disposal and value in use. Let's say that your investment in associates account has a carrying amount of 3 million. Pero ang fair value less cost of disposal mo is 2,500,000 and ang value in use is 2 million. So looking at the given data, we could say that we have an impairment loss kay di ba mas lower ang fair value less cost to sale and value in use compared sa carrying amount to your investment. Other changes in equity. In other changes in equity, the carrying amount of the investment should be adjusted. For example, if there is a revaluation surplus, the investor should have also a share in it and will increase its investment in associate account. In associate is 20% as a consequence of which the investor has significant influence over the investee. The investee reported the following for the current year: net income 6 million, dividend paid 2 million, revaluation surplus 3 million. Journal entries for current year: share in net income, debit, investment in associate 1,200,000, credit, investment in investment income 1,200,000. How it comes to 1,200,000? 6 million multiplied by 20%. Number 2, share in dividend paid, debit cash, 20% of 2 million is equals to 400,000. Credit investment in associate 400,000. Number 3, share in revaluation surplus, investment in associate 600,000. Revaluation surplus, investee 20% of 3 million is equals to 600,000. Investment in associate other accounting issues has technical knowledge, which are to know the equipment of upstream and downstream transaction between the investor and associate, to know the procedure when the investor ceases to have significant influence, to understand the recognition of an investment in the associate achieved in stages, to know the accounting for equity investment of less than 20% under the fair value and cost method, to recognize a change from fair value or cost method to equity method. Adjustment of investee's declaration. The most recent available financial statement of the associate are used by the investor in applying equity method. The difference between the reporting date of the associate and that of the investor shall be no more than 3 months. If an associate uses accounting policies other than those of the investor, adjustment shall be made from the conform associates' accounting policies to those of the investor. Profit and losses resulting from upstream and downstream transaction between an investor and an associate are recognized in the investor financial statement only to the extent of the unrelated investor's interest in the associates. Upstream transaction, sale of inventory from associate to investor. In the example given, the investee reported net income of 2 million and paid no dividend. Also during the year, the investee sold inventory costing 200,000 for 300,000 to the investor. The inventory is unsold by the investor on the year end. So ibig sabihin, ang 100,000 unrealized profit from the inventory should be eliminated in determining the investor shares in the profit or loss of the associate. So ang basis mo in determining the share in net income would only be 1,900,000. Of equity method, change from equity. First thing that we are looking for in an investment to be considered as investment in associate is the significant influence. However, If the significant influence by the investor to the investee was lost, it should discontinue using equity method. For example, an entity purchased 30,000 ordinary shares of the 10,000 outstanding shares of another entity, representing 30% interest several years ago. At year-end, the investment in associate has a carrying amount of 6 million. On the same date, the investor sold 20,000 shares for net proceeds of 5 million, resulting to a loss of significant influence. The quoted market price for such investment is 260 per share on the date of sale. To record the sale, you would debit the cash received 5 million and credit investment in associate of only 4 million. 20,000 divide 30,000 times 6 million and recognize a gain on sale of investment of 1 million. And then, diba, quoted siya at 260 per share. So meaning, as of that date, kailangan mo i-remeasure ang investment in associate mo. 260 multiplied by 10,000 shares is 2,600,000, pero ang carrying amount sang 10,000 shares is only 2 million. So may gain ka in remeasurement of 600,000. It will increase your investment in associate account. Then after that, i-reclassify mo na siya as financial asset at fair value through profit or loss, kay wala na naman significant influence over the investee. Debit financial asset, fair value, profit or loss, 2,600,000, then credit investment in associate, 2,600,000 para ma-close ang investment in associate account mo. Associate held for sale. The investment in associate classified as held for sale shall be measured at the lower of carrying and fair value less cost of disposal. 20%. If the investment is less than 20% and does not have significant influence, it should be accounted for using fair value method or cost method. Fair value method is applicable to financial asset measured at fair value through profit or loss, and financial asset measured at fair value through other comprehensive income. Cost method is usually applied with respect to investment in the unquoted equity instrument or no marketable equity investment. For example, an investor purchased 10,000 shares of the 100,000 outstanding ordinary shares of the other entity at 200 per share. The investment is unquoted and represents a 10% equity interest. Here, the investment is unquoted, thus we will use the cost method. Debit investment in equity securities 2 million and credit cash 2 million. From pre-acquisition retained earnings. When you are using fair value and cost method, the dividend received from the investee will be recognized as dividend income regardless if it is from pre-acquisition or post-acquisition retained earnings. Illustration, cost method. On January 1, 2019, an investor purchased 10,000 shares of the 100,000 outstanding ordinary shares of another entity at 200 per share. The investment is unquoted and reported a 10% equity investment. Journal entry, debit investment in share, 2 million, cash, credit cash, 2 million. How it comes with 2 million? 10,000 shares multiplied by 200 per share equals 2 million. Number 2, the investor reported net income of 1 million for 2019. No entry is required. The investor does not recognize a share in the net income of the investee. Number 3, the investor received a 20% share dividend in December 31, 2019. Memo: received 2,000 ordinary share from investee and 20% share dividend on 10,000 original shares now held 20,000 shares. Number 4, the investor reported a net loss of 3 million for 2020. No entry is required. The investor does not recognize a share in the net loss of the investee. Number 5, the investee declared and paid a cash dividend of 1,500,000 on December 31, 2020. Journal entry: debit cash 10% of 10% multiplied by 1,500,000 is equals to 150,000. Credit dividend income 150,000. Number 6, the investor sold 3,000 ordinary shares at 250 per share on December 31, 2020. Journal entry: debit cash 750,000. Credit investment in shares 500,000. Gain on sale of investment 250,000. Sale price 3,000 multiplied by 250,000 is equals to 750,000. Less dividend from pre-acquisition retained earnings. When you are using fair value and cost method, the dividend received from the investee will be recognized as dividend income regardless if it is from pre-acquisition or post-acquisition retained earnings. Investment in associate achieved in stages. The investment in associate achieved in stages is not covered by PAS 28. However, this is a parallel to a business combination achieved in stages. PFRS 3 paragraph 22 provides that a business combination achieved in stages, the acquirer shall remeasure previously held equity interest at fair value and recognize the resulting gain or loss on profit or loss. Approach. The existing interest in the associate is remeasured at fair value with any change at fair value included in profit or loss. However, if the existence interest is accounted for at fair value through other comprehensive income, any unrealized gain or loss at the date the investee becomes an associate is reclassified to retained earnings. The fair value of the existing interest plus the cost of the additional interest acquired constitutes the total cost of the investment for the initial application of the entity method. The total cost of the investment for the initial applications of the equity method minus the carrying amount of the net assets acquired at the date significant influence is the obtained equals excess of cost over carrying amount or excess net fair value.